Hi, this is Kevin from Mr. Finance, and in this video we're going to look at the balance sheet from Mr. Finance. At the top you can click on where it says company name and enter your company name. Underneath it is balance sheet, which is the title of this sheet. Underneath that is the date, which is automatically updated for you. Then you'll see you have your assets columns, your current assets, non-current assets, and your total assets. You come over and have your liabilities, which is your current liabilities, and then you have your long-term liabilities, or non-current liabilities, and then you have those will be totaled up, and you have your owner's equity, which is how much you as the business owner have put into this to help even out what your assets and liabilities are, which is then added into your total liabilities to total owner's equity, which your total liabilities and owner's equity should equal the same number as your total assets. And so your current assets are anything that anything you will receive within the next 12 months. Your non-current assets are any assets that you have that are long-term assets, such as investments, properties, and stuff that you're not going to touch for a long time. And so what defines current is anything within the next 12 months, and non-current is greater than 12 months. And the same thing on your current liabilities. These are debt obligations that you have to pay within the next 12 months. And then your non-current liabilities are liabilities that are like loan payment, like loans that are greater than 12 months. So these are like your yearly payments, and this is what's left. Like I said, everything that is in the dark gray will be calculated for you, so no need to worry about calculating that, so that makes it easier. And then also off those calculations, it'll come over and calculate these ratios for you. So you have 6 total ratios. You have 4 for liquidity, and then 4 for solvency. And your solvency is a measurement of how much ownership the business owner has to the ownership of creditors, or like in instance, if you had a loan from operating loan from a bank, or you're taking out a loan from a bank, then how much the bank owns. So up here in liquidity, your current ratio is the ratio that is mainly used to give an idea of a company's ability to pay back short-term liabilities. Your working capital is the owner's share of the liquid assets. The quick ratio is an indicator of a business's short-term liquidity. The cash ratio is the ratio that is generally a more conservative look at a company's ability to cover its liabilities than the other liquid ratios. Then you come down to your solvency. You have your debt to asset ratio, which simply compares the owner's and the creditor's percentage of the business. Then you also have equity to asset ratio, which measures the owner's investment in the business. And so you can find this product at our shop at etsy.com/shop/Mr. Finance, or you can find us on Facebook. And if you have a smartphone or a device that can read QR codes, you can take a shot of this QR code and it'll link you to our Etsy shop. Thank you.